So we're going to look at question number 1 in evaluating a bond. So bonds, we know, are long-term debt instruments that can be issued by a government or a company. So we have what we call coupon bonds. These are bonds that offer a certain interest that we call a coupon interest. So bond valuation falls under the principle of time value of money. So I'll take you through a quick principle on calculating the value of the bond, the formulas, how to calculate YTM, as well as how to calculate the yield to maturity. Then we'll look at that question. So uh, basically, I would want you to learn how to use the formulas themselves rather than the tables. So quickly, the value of the bond is simply given by the coupon interest, which is a capital I, and the present value annuity, PVA, plus the value, the face value, and the present value factor. So a bond can be a premium bond just by looking if the coupon interest is more than the market rate. A bond can be a discount bond if the coupon interest is less than the market rate. A bond can be a par bond if the coupon interest is equal to what? The market rate. So the market rate is what is used to calculate the discount factors, whereas the coupon interest, the only job that it does is to calculate the coupon interest. So with that being said, suppose we're given a bond with our coupon interest of say 8% and our market rate of say 10%. And this is a 3-year bond which has a par value of 1,000. So time value is 3 years. I need you to follow me closely because this is what I need you to apply. Now this bond has its par value or face value of 1,000. So we want to calculate the value of the bond, the annual bond, and also calculate the value of the semi-annual bond. Number 1, let's calculate the value of the bond. So to calculate the value of the bond, we first calculate the capital I. So our capital I, which is the coupon value, is simply calculated by the coupon interest, small I, times the face value, MV. So we have 8% over 1,000, which is 80 kwacha. So that's where the job of the coupon interest ends. So here we're going to have 80 kwacha. So we're going to put 80 kwacha where? Here. Then we have our base value, which is 1,000, and our coupon, the interest factor. So what is remaining here is to calculate the two factors. You can use a table or you can use the formula. So the interest factor is simply found by 1 plus KD, the power what? The power time T. So what is our KD, our coupon interest, our market rate? 10%. So 1.10. And our time is what? 3. So what do we get when we calculate that? 0.751, right? So that is the value that we put here as our coupon, as our present value interest factor. 0.751. So this is the present value interest factor. So to calculate the present value annuity factor, 1, calculate it as follows: 1 minus present value factor over the KD. So this will be 1 minus 0.751 divided by the 10%. Calculate for me.
Given 2.46, 2.4868.
Okay. 2.4
Or 8, maybe round it off to 7.
47.
87. 487.
2.487. Okay, are we
7,
agreed?
yes.
2.487. Okay, so let's calculate the overall. Okay, that's the value of the bond.
The total is given 949.94.
9.
949.995.95.
Okay, so this is the value of the bond. What kind of a bond is this? It's a discount bond. Okay, so it was sold for less than the face value 1,000. So this is the value of the bond. Now this is the annual bond. Are we following together? What did you do? The coupon interest was 8% and the market rate was 10% for 3 years. So the job of the 8% was to produce what? The value, the coupon value of the bond. So 8% of 1,000 is 80. This is where the 80 came from. Then the job of the market rate is to calculate the interest factor. So we started by calculating the present value interest factor, 1 over 1 plus 10%, which was 0.751, which was that. Then 1 minus the interest factor over the R or the KD helped us calculate the annuity factor. So this is what we have here. All right. Then we go to calculating the current yield. Our current yield is actual return that the investor gets on the bond. It is given by the coupon value divided by the value of the bond times 100. So what is our coupon value or the coupon value? It was 80, right? So 80 divided by the selling price of the bond, which was 949.5 times 100. What is the
No, there is
percentage?
supposed to be 0.995. 0.95.
Or here, we're 95.
Yeah.
Oh, thank you. 95. So what are we getting there?
8.42.
8.42%. Now, suppose we're not given the market rate.
20 minutes.
Okay, suppose we're not given this 10% market rate. All right, and we are told find the yield to maturity. Find the yield to maturity. Yield to maturity is also the market rate. Okay, suppose we're told to find the yield to maturity given that the coupon interest was 8% and the selling price of the bond was 949.95. And we're also told that the time in years was 3 years. So we're asked to find the yield to maturity. So what is yield to maturity? Yield to maturity is simply the return What is yield to maturity? So when dealing with yield to maturity, we're talking about the total return that an investor will expect to earn if the bond is held until it matures. So we assume that all coupon interests are reinvested. So now the formula for yield to maturity is given as follows. Of course, in the olden times, we used to use interpolation, but the formula that we use is the coupon payment, I plus MV minus VB over N divided by uh, 3VB plus MV divided by 2. All right. So what is our coupon interest? And we are told that the par value of the bond here, or the FS, is 1,000. So help me, how do you find the capital I? What's the formula for the capital I?
So you multiply 8% by the face value,
Yes.
so it will give you 80.
So 8% times the face value will give you 80. Okay. Plus the face value here is what? 1,000 minus the value of the bond was 949.95. What was our period? End? 3 years. So put 3 years there. And 3VB, when you calculate there, you're going to have 949.95 plus the face value of what? 1,000 divided by 2. So when you calculate that, you simply get approximately 10%. This is how we calculate the yield to maturity. It takes us back to what we had initially there. Now, this is for an annual bond. When dealing with a semi-annual bond, the principle is simply the same. From our time value of money class, remember, when it's compounded annually, the formula is normal. But semi-annually means how many times are you compounding? Twice. So semi-annually is 2.
Hi, Collins, I didn't finish writing.
I'll share the video. I grabbed what I had, sorry. So now I want us to consider the same bond. Suppose we are told that a bond is issued at par value 1,000. So the par value is 1,000. And we are told that the coupon interest is 12%. And the market rate is 10%. And this bond is scheduled to run for a period of 5 years. Semi-annually. What does it mean that semi-annual, it pays twice in a year? Calculate the value of a bond. Can somebody help me? What is the formula for the value of the bond? Value of the bond is equal to what? Capital I. Present value, annuity, plus the MV, present value factor. So by seeing this bond is a premium bond because the interest is more than the market rate. Now it's a semi-annual. Whenever it's semi-annual, you need to adjust 3 things. All interest rates, whether it's a small I or it's a market rate, you divide them by the number of compoundings. by 2. And the time, you multiply it by what? 2. Those are the adjustments we're going to have. So our coupon interest, instead of 12%, what are we going to have?
We are going to have 6. Oh,
6%.
yeah, 6.
Correct.
6%.
Then our market rate, instead of 10%, we're going to have what?
It's going to be 5%.
5%. Correct. Then our time, the periods, instead of 5, we're going to have what?
We are going to multiply by 2.
Yes.
So it will be 10.
10. It is to be 5 years, but 10 periods. All right. So now, what becomes our capital I? What becomes our capital I? Small
It's
I
going to be 60.
times MV. Good. How do you find the 60? 6% of 1,000. So what do we get? A 60. So where are we going to place the 60? On the capital I here. Okay. Are we all following out together? Anyone lost? Then our interest factor. How are we going to calculate the interest factor? PVF 1 over 1 plus R at the power time. So what R are we going to use now? Or KD? 5%, right? So 1 over 1.05 to the power what?
10.
10, correct. So give me what becomes our PVF?
It's 0.614.
0.614. Okay. Then how do we find our annuity factor? 1
We
minus
subtract, 1 minus what we found now.
divided by 0.05.
I'm getting 7.72 if I've done it correctly.
7.72.
72.
Okay. So here 7.72. Then here 0.614. So now it becomes a final value of our bond.
Uh, 1077.2.
Okay. So 1 0
077.
1077 point what? 2. So what kind of a bond is this? It's the premium bond, right? Are we together? Have we left anyone out? Okay, so now we can address the question. Let's now identify the information we've been given here. So it looks a little bit clustered, but let's get the principle. So Adia Limited is a Zambian company that issued 100,000 par value bond on 1st January 2010 with 6% coupon interest rate and 30 years to maturity. The bond pays semi-annual with originally aimed at attracting institutional investors such as pension funds, insurance firms in Zambia. As of 31st December 2024, the market rates fluctuated significantly due to changes in servicing costs and shifting monetary policy. You have been hired as a fixed income analyst to assess the current value of the bond and advise how pricing changes based on the prevailing market views. So you're required to calculate the market value of the bond as of 31st December 2024, and the required returns are 5%, 6%, 10%, assuming semi-annual. Okay, so let's help me identify what we have. What can you identify from there?
Yes, we can pick the face value, which is 100,000.
Okay, 100,000. Okay. Please let's apply what we were learning there. So the FV is 100,000. What else do we have?
The coupon interest,
Coupon interest is what?
6%.
6%, small I. What else do we have?
We also have our T,
Mm-hmm.
which is 30 years.
Which is 30 years. Our T is 30 years. Where is the T coming from? The 30 years.
After the words coupon interest rate and 30 years to maturity.
Okay, 30 years to maturity. So our T is 30 years. Okay. We'll put 30 years. Now,
So another word that we can
I need you
underline
to
is
be very careful.
semi-annually.
Uh-huh.
Semi-annually, meaning it's paying twice in a year.
Yes. But wait a minute. What is a maturity? It is 30 years to maturity. It was issued when? January? When was it issued?
2010.
2010.
Oh, yeah, 2010.
2010.
Uh-huh. To when?
2010.
Mm-hmm.
2010,
So
is it to 2040?
we have 15 years left. Can someone explain why we have 15 years left as our T? Then you multiply by 2 to get what? 30 years.
Yeah, because the bond was issued in 2010.
Uh-huh.
Now we are calculating it as that we are considering the date that we are doing it as at 31st December.
Mm-hmm.
So we are removing those years that have passed.
Mm-hmm.
So we are considering
Rounding.
now from 2024 to the years that had remained from the date that it was issued.
Exactly. So calculate. Is it tallying to 15 years left?
Yes, it is.
It is, eh?
Yes, it is. Yes.
So I'm very happy that you're following. So our T is what? 15 years. All right. So I is what? 6%.
So maybe just wait. Why is it giving me 14? Because when we say 2010 to 2024, it's
Mm-hmm.
supposed to be
Yes, I'm
years,
also getting 14.
not 15.
Are you calculating the actual itself?
Yeah, yes, because when we start
I think so.
itself,
Count properly. Interesting.
2010 itself,
Mm-hmm.
so 2010, 11,
Mm-hmm.
12, 13, 14, 16, 17, 18, 19. 2021, 2022, 24. Um,
So how many years are there?
I
yeah,
think it is
so it's
2010 it was
15.
15.
15.
Are we together?
But, but when you use the direct calculator, then it will give you 14.
Yeah, because starting at the first of the month, I'm glad you are thinking in that line. Okay, great. So our coupon interest, 6%. Why are we dividing by 2? Semi-annual. So 3%, right? Market rate. Oh, before we go to market rate, time is what? 15 years, but we're multiplying
So
by 2,
we are going to
So,
have
30 period.
30.
Mhm.
7 point.
Okay. The PV, per value or MV is 100 what? 1,000, right?
Yes.
Then
Yes,
the KD, they are varying, okay?
yes,
We're
yes.
going to vary depending on where we're calculating. It's 10 marks. So we can start A at what? 5%. If it's 5%, what are we going to use? 2.5, right?
Yeah.
2.5%. So what's the value of the bond in this case? So what is our I? Our I is going to be 3,000 here. Plus 100,000 and the interest factor. So we can use a table or we can use the quickest form. The interest factors are calculated as I gave you, which is 1 over 1.0 what? 025 to the power what? 30. You know where that's coming from?
sorry, the I, is it not going to be, is it 2,500?
No, the I comes from the big I, all right? The small I,
Okay.
3% times 100,000. Calculate. Hmm? Are we together? Are you following?
Yeah, so
Yes,
the
so
interest
um,
factor
Mm-hmm.
is
um,
0.477. 477.
0.477. So it comes here. Then how do we find our need factor? 1 minus
0.477.
0.477, divided by the interest of what?
0.25.
What do we put here?
0.25.
0.025. Uh-huh.
20.93.
20 point.
93.
Are we agreeing?
I'm getting yeah in the same line, but mine is saying 0.92.
It's within.
I'm also having
Okay, I
0.92.
didn't round off, so
Okay, what's the final answer? He didn't round off the final answer, probably. Yeah? Then what's the value of the bond? Mm-hmm.
It's given 110 for 60.
110 for 60. Okay. So it's a value at 5%, the value at 10. I don't need to go through this, but the concept is just for the first one. All right? Do we get the concept?
Yes.
Is it clear? Do I need to do 6 and you only have 5 minutes to go before the session ends so that I cover the other?
No, it's okay. It's
It's
okay.
okay. No one is behind, right? So the concept here, so for which of the three scenarios above indicate whether the bond is trading at a premium, discount, or par? Remember, I explained what a discount bond is and what a premium bond is. Okay? Which one is a premium, which one is a
Yeah.
par, and which one is a discount bond? You can
So
complete.
the one at 5% is
Uh-huh.
trading at a discount.
The one at 5% at a discount. Uh-huh.
No, that one will be a premium because the difference is the coupon rate is higher than the market interest.
Exactly.
Then
I'm
that
so
that
happy.
bond will be a premium.
I'm so happy.
Then if
Good.
the coupon rate is equal to the market rate, then that will be the par.
Mm-hmm.
If the coupon
Oh,
rate is less than the market, then it will be a discount.
Exactly. So Malabika 6% to compare, right? Which is our coupon. So here at exactly it is a par bond. Ideally, we want this guy to be more for it to be a premium. So it is only more upper. So here it's a premium, here it's a par, and here it's a discount. Now you understand why I needed to explain these principles, eh? Are we together?
Yes, we are.
yes, we get it now.
So you don't even need to calculate
Sorry,
individually.
I'm behind.
Uh-huh.
Colin, sorry,
Yes,
I'm behind. Where you've said here it's a premium, here it's at par.
okay. So initially in my
Just a
preamble,
conclusion.
I said the rationale for determining if the coupon interest is more than the market rate. What do we call this? A premium, right? Are we together?
Okay,
So here,
okay,
6%, it's more than 5%. So it's a premium at 5%, right?
okay.
Then whenever the coupon interest is equal to the market rate, it is called a what? Per bond.
Par.
So 6,6, it's par. Are we together? So pali ni par. Then whenever our coupon interest is less than the market rate, it's called a discount bond. So pali 10%, it's a discount bond. Are we together?
I'm okay now.
Anyone else who's behind? Okay. Then the last part of the question here is asking, what is the last part of the question? Is asking, critically interpret how changes in the market interest rates, which are the YTM, will affect bond prices in Zambia's financial markets. So there's a relationship that they have an inverse relationship, in fact, bond and bond prices and the interest rates, okay, generally. So that inverse relationship can be epitomized by this curve. I was teaching the other group yesterday. Okay, so when the price of bonds increases from P1 to P2, the yield maturity will decrease from YTM1. So this is just a norm, it's a principle. So there's an inverse relationship. So when bond prices will fall, when the yield will rise, for instance, from 10, if you did the calculations, you'd even compare the values there, which was 69 at 5%, it gave 110 at 10%, so and vice versa. Zambian specific risk volatility, you can explain that in terms of exchange rate volatility. So the depreciation of Zambian kwacha will fuel inflation and prompt monetary tightening through the Bank of Zambia. Also, David servicing costs. Okay, so these are just theories, the notes which I sent already. So we're done with our first session on the bonds.